So the ADR generates and populates this every single day. We have the open, that's the opening price of the day. And then we have 100% going up, 100% going down in 25% increments. It's going to give the amount of pips from the open, and then it's going to have the price to the side, the price of the currency you're trading. Almost every day, the 25% is hit in either direction. So it can either hit the green side, 25%, or the sell side. It's not guaranteed to hit both every single day, but one of them will be hit every day. It could be both every day. It also has a high chance to hit the 50% every day, especially depending on what pair you're trading. The more that pair moves, the more it's going to hit. It has a 75% chance to hit the 75%. And then on a good day, news or something like that, it'll hit the 100%. Now, the way this works, if I did something like get into a trade today and I set my TP for the 100%, because that's usually how I do it when I call trades. This 100% today is going to be in a different position tomorrow. So if you do see me put in a trade, that's why I set alerts. If it hits all of these targets and takes 2-3 days to hit it, and 100% is somewhere down here on the day that it hits, for example, I'm basing it off of where it was when I actually placed this trade. I just want everybody to take a note of that. So it'll be in different places. And so I make sure I go and I set alerts so that I can still see the lines on my chart, because these are going to be in a different place tomorrow. When you go to the ADR and go to settings, I have mine set up with the pane labels and the lines. That's just showing the 50 pips, the price, and then the green lines and red lines going across the chart. I don't have on the tables. That popped up here to the right up here. To me, it just over clutters my chart. I don't need it. So if you come and set this up, I take that off. And then inputs and status line, I take that off because it just over clutters the chart. You can trade the ADR the same as that way you do the trade zones. Same as that way. So what I'm going to do is you can show the past ADRs, and it's automatically is going to mark up what already happened. When you come to the ADR, you're going to go to inputs, and you can go to show past ADRs. And you see all of these popped up. It goes back 5 increments. So this is the day. That means it's going to show the previous 5 days. I'll get into this after I explain the day. You can go back to the week, and it's going to show the last 5 weeks, and then it can show the last 5 months. Those are for my higher time frame traders that's on the 4-hour daily charts and higher. I also do that if it hits 100% of my targets on the day, and I want to stay in this trade. I'll go to the week, and it'll give me more targets. And what we're going to pay attention to is the gray line. This gray line is the open of each day. So we need to know where that's at first. So I'm going to do this day by day. This would have been the open of the day. We got a W right here, ketchup across the mustard. And if we wanted to take this buy, this would have been our first target. And then that would have been our second target. And it hit both of those targets just in this day alone. So here, for example, the scanner gave off a buy. It was right at this one. We would have went to the very next ADR right here as our first TP based off the ADR alone. So I had to put my buy in right here at the open of that candle. Found my stop loss. Now, if I base this off, I'm going to do this off the ADR alone. This right here would have been my worst case for a stop loss. It's below the low of the day, and there's a W right here. When I go down to it, it's at 23 pips. So I'm going to go see, and I'm going to mark up 23 pips for my target. Make sure that we got a 1 risk to reward ratio. In real time, when I took this, like if I would have took this, that would have been my first target. I wouldn't have set an alert on this line as my first TP. And let me see, that would have been 11 pips. And then I would have took it to the next ADR. Let me see, hold on, let me find 23 again. There we go. So after it hit that, it would have hit it right here. My second TP was my 1-to-1 risk to reward ratio. It's not showing the other green lines. I think it's because it didn't hit them. I can't say that either, though. I don't know why it's not showing it. It's lagging. I see it showing for the next days. Yeah, I wish it would show it. Looking at the space in between these, that's how far they are. So if you can see the space, how much these are on this side, that means the other ones were just as close. And it looks like I would assume they hit all of them. This was the first one, the second one. It looked like it would have hit the third and fourth. It would have went over all of them. So on that day, all the targets would have been hit. That's how I would base this using the ADR. So we come in here and we take this trade. Scanner went off. And we get into this buy. And I want to use, let me see. Let me make sure I find it. Make everything as big as possible. And so buy, open of the candle. And if I want to use the ADR on this side as the stop loss, that was 14 pips. If I took it to the very first ADR right here, that'd have been close. It wasn't quite a 1. It's at 0.96, 97 for my 1-to-1. I could have took it there. It was close enough. It was about 0.4 pips short of being the same. But if I want to and I just go, I would have took that if it hit it. But it did hit it. But if I wanted to make it a 1, they're so close. That's why I would have just went for the first one. I wouldn't have waited for it to actually hit a whole 1-to-1. I would have just got out with there and took it. So I could have used that as my target, and then my second target would have been the next ADR. Now, in this situation, it would have came and took me out if I would have just held this trade. Like it would have hit my first target, and then it would have came back. And by that point, I got my stop loss and profit. That trade would have been over with. But when it came back to the ADR, because you can trade this the same way as the trade zones, it bounced off the ADR. So it came and hit it and then made a W and then it catch up a mustard cross. So I could have got back into this buy if I wanted to take this trade off the ADR. In the worst case, I wait for the candle to close above the water. That would have been my latest possible entry, which means I would have entered right there and had my stop loss below this area, below this zone where the W happened and where the catch up and mustard cross. So I want to put it below that so that it's out the way. Once I find that spot, I'm going to go look for my 1-to-1 risk to reward and make that a 1. It's close enough. I would have entered right here Off of this entry, this would have been my first target based off the ADR. That was only 11 pips with a .5 risk to reward. If I want to go for the second ADR, I would have had a 1.24 risk to reward, and it would have hit that target. Now I come and put my TP at the next one, which is right here. I would have been at a 1.94, pretty much a 2 risk to reward. And then the final target got you at 2.62, and it came and hit that last target. That's how I use the ADR for my stop losses and my TPs. And pretty much the same thing as the trade zones. So here, I was just saying this, when we taking those buys, we would have took that buy until it didn't work no more. So if you would have took this buy based off the ADR, it never hit it. If I would have took this buy, that would have been my trade to lose. You took your trade for the day and you lost. The scanner didn't work on that. You're done with it. We're not out here chasing the rest of these, because all of these, none of these would have hit. We would have took one and you done. So you come up with your own trading plan and you want to learn how to take more than one trade a day when you lose a trade, then you come up with that plan based off of your own habits, and you would take more trades. But as a newbie, for the ones that's learning, beginning at this, you would have took one trade and lost, you're done with it. That's it. This was what? Thursday? So based off of that, we would have won this trade, you'd have won this trade. And if you took that right there, that last one I showed based off the ADR and took that buy, that would have been 3 trades. All with good risk to reward ratio, even losing this one trade at the end of the week, you'd have made money for the week. I also don't suggest trading Friday as a beginner until you know what you're doing. Friday is always a consolidation, reversal, whatever it does a fake out day. Tuesday, Wednesday, Thursdays, they usually go the same way. Usually it does the trend middle of the week. Monday is also like a Friday. It's the consolidation stop hunt phase. It does all the crazy, like this did a whole whipsaw thing. So until you master Tuesday, Wednesday, Thursday, then you can lead into Mondays and Fridays. That's going to go along with the 5 phases, which is the first class of this course. And you'll learn how to trade those Mondays and Fridays based off to what phase you're in. Once you master that stuff, you can trade it. But it's suggested don't trade Monday and Friday. So that's how we actually would have did that. Now, I'm still going to go over it because I would have did it. Taking these sales off of the scanner, we got an open price right here. This is where the market opened. So our stop loss would have been up here at this green target for the sale. And then our TPs would have been this red one right here, which it hit. So what does that look like? We're going to come in, go to the short. We're going to put our forecast on. Let me zoom in on that. Let me see, we got a sale right here. Open to that candle. Yeah, that would have been down there. Yeah, right at the open. So the open was actually the entry. That's where the scanner gave off that sale. I go up here to my stop loss, that's 16 pips. So since the entry was an open and the stop loss is the first ADR this way and the target is the first ADR the opposite way, it's automatically going to be a 1 because they're going to be the same length from each other. So that would have been good to go. I could have got into the sale with my stop loss up here and it would have went into profit, came up, negative. Let's say I just let this sit for the day and then went back in the profit here and then hit my target here. That's just strictly off the ADR. We could have did something like still got out at the blueberry if we wanted, which would been a little sooner. And then if I wanted to hold that sale, this is an example of where my ADRs are the previous day, they're different on the next day. So if I came and said I got into this one sale and wanted to hit all these targets, and I just put them in like that. Because that's how I do it when I call the trades anyway. Always go to the 100%. You never know, it could hit all of them. If I would have just took this one trade, this sale, and hit that target, okay, cool, take some money. Next day comes in, I would have had an alert right here. I line my line up with it, with this ADR right here. Go to the plus side, hit an alert, bam. It would have came and hit that alert. The next day, it hit it right here. Let's say I'm still holding. I'm gonna check that in a minute. If I was in that, my next target would be right here, which it looked like it's gonna eventually hit. Gonna end up coming down here and hit this target. I'm gonna pay attention to this for the rest of the week. If this keep giving out sales, I'm gonna call those sales. Let me check the question in the chat. Oh, yeah. Thank you. Based off the ADR alone, and I'm gonna tighten this up real quick because it's all pretty much the same thing after this point. If I wanted to take this sale, this one's real tight because this looked like, yeah, that hit it. It's like right there on it. And so you still want to do the thing of giving it a few pips, and that would have been safe. Especially looking at this realistically, it had the blueberry right here, right next to the ADR. You don't want to put it right on it because stuff like that can happen, and it held the blueberry and the ADR at the same time and then traded off of it. So it depends. There's a lot of ways this trade could have been taken. If you did it straight off the scanner and put sell and went and put your stop loss a little bit above the ADR and then took your TP to the first ADR for your target, you would still be in this trade right now and it would have got close to it. Another way you could have entered off of this is off the ADR itself. And so when it came up and hit the ADR right here, you could have waited for the catch up and mustered across down and then got in your trade, knowing that there's a small M. It held the blueberry, it held the mayo, catch up across the mustard. In worst case scenario, you waited for it to close below the water. And that would have been an entry. More realistically, that would have been my entry. Well, how I trade. That would have been my latest entry. As soon as this ketchup and mustard crossed off that mayo and that blueberry like that, and I was trading Euro USD like this, that would have been my entry. Right after that cross, and it would have been up in here. And I'd have had my stop loss above the ADR and the blueberry like that. And that 1-to-1 would have already hit here, which would have been the open price, the gray line. That would have been my first target. And this would have been my second target off that ADR, which ends up being 21 pips. So I still would have went for 20 pips. And the third target would have been down here, which was 36 pips. So by the time I got to 30 pips, I would have been taking that. I would still be in there right now if I would have traded that. This is probably going to keep selling because everything just crossed like that. I'm going to look to trade this the rest of the week. Now I'm gonna dive into the weekly ADR just to give an example. This is going to be for my higher time frame traders, at least a 1 hour, 4 hour chart, especially if you're doing that macro check down and then you're waiting for the consolidation stop hunt entry phase on a Tuesday or Wednesday. This is where this one thrives the most. It's only Tuesday, so I gotta show last week. You would show the past ADR. It's gonna go back 5 weeks. Perfect example. This is perfect. You got the open of the week right here last week. And if you trade, you can trade straight off the ADR, and as soon as this stuff populate into your trades. I still wait for the confirmation. That's just if you was doing it straight off the ADR itself. I'm still gonna wait for my W's, my M's, my catch up and mustard cross and all that good stuff. So if I went in here and enter off the open of the market and went and put my stop loss at the first ADR for the sell and then my TP as the first ADR for the buy. Oh yeah, that's it right there. So that 25 from the open is automatically always going to be a 1. They're going to be the same amount of pips. So this is Sunday, Monday right here. Beginning of the week. So that means if I'd have entered, soon as this ADR populated, it's automatically going to give you the stop loss and the TPs for the rest of the week, soon as Monday opens. So if I did that and opened this, it would have came up and hit that first target on Monday. And if I held this, it came down close to the stop, never hit it. So every time this scanner did a buy, that's another entry. Also, every time I notice the W and the catch up and the mustard crosses up, it's an entry. And if I wanted to just hold this one entry for the week, I could have. So that first target hit, that's the second target right there with the green line. That would have been my third and my fourth target for the week. It came and hit the first one, and it came and hit the second one. And then that was it for the week. So what does that look like with what I explained? This is for my higher time frame traders. With the Monday consolidation stop hunt entry, this would have been the first real legit entry. It would have came and hit that target there, hit that target there, continuation, and then it would have did this midweek reversal here Thursday off of the ADR and crossed this way back down and came back to hit the ADR going the opposite way again. And it just consolidated the rest of the week after that. For a weekly 1 hour chart, it's honestly not bad. I would have tightened this up though. That's a whole nother situation. But based off of this alone, the stop loss never would have been hit off this first ADR up here. And this would have been our first target. And it hit it here. So we would have entered at the open of the week. That took the second day to hit that. And so what we could have did was every time it hit the open, you got into another sale. So it hit the open here, same as it does the 4 hour trade zones. It hits the open and then it wicks it and comes and closes right back below. So it could be the very next candle. You can wait for the catch up and mustard across. Whatever confirmations you need, you could have kept taking these sales back down to the first ADR. And then it got here. And this is on the week where I'm selling. These I wouldn't have took because now we got a big W right here. So the first 2 days with these M's, open of the week down to the first ADR, and then this M right here down to it again. That's just Monday and Tuesday. Wednesday came in and it did a W off of the ADR. It hit it right here, catch up crossed up, crossed back down, and it did a W here, shift candle right there, and the catch up crossed the muster backed up. So now we could have did the buy up to the ADR. Let me show what that look like, and it never completely hit it. So what we're going to look for is to see if our one-to-one risk to reward hit it. We're going to go below the W. We're going to find our one-to-one. That's it. And based off the entry off this W, catch up and muster crossing off of the ADR, our target would have been hit here. It went as high as here for the week. So that would have been a 1.8 risk to reward. Would have risked 24 pips and gained 43 pips. 43, 44, depending on where you got out at. Friday came in, done for the week. This was perfect because the scanner gave off the sale right at the beginning of the week. This is our open right here, the gray line. So we're going to come in here, put in our short sale forecast and see how that played out. Entry right on the open of the week. Stop loss here. On the first ADR going up, we can go a little bit above it if we need to. Always make sure you do actually give yourself that breathing room for the spread, because the candles could do something like come up and hit it and then go right back down the rest of the week. So you always want to get a little space on your stop loss. Okay, first ADR right here for the TP, that would have hit. We got the second one right here. That hit the target there. We got the third one here. It hit that target. And this one ended up hitting all 4 targets 100% for the week. Now, this is real key because it's going to show you how this plays out. So we got Monday, Sunday, Monday, Tuesday came in, Wednesday came and hit the 100% ADR for the week. Ooh, there's some people I wish was on this call right now. This is midweek reversal from the first class, the consolidation stop point entry, catch across the mustard. You could have traded off of this 100% ADR after that sale. So, of course, the scanner gave off the sale. That's the easy win. But what do we do when the 2 to 3 days play out? And now we're looking for the midweek reversal. We got a railroad right here, off of the ADR, catch up cost of mustard going up. This ADR right here could have been our first target. Hit it. Could have used the water as a target. Hit it. Came and retest that ADR to give the actual W, catch up cost of mustard up. And we could have traded that to the ADR again there, the ADR again right here, and the ADR right there. And we would have caught the Wednesday up till Friday and been done for the week. Now, you can't make that up.
Then last question.
Go ahead.
What does ADR mean?
Average daily range. When you go to TradingView and you type it in, it's going to pop up. I use the SADR. There's a lot of ADRs on there. Switch FX, average daily range. That's the one I use. If you go in there and just put ADR, you're going to see a bunch of them. They're all pretty much the same. This is the one I like the most. What it is it gives you the prices of the average amount that that pair moved on the previous day. So it gives you an average of what it think it's going to hit based off of how it previously moved. That's why every time these populate, they're not in the same exact spot. they're not the same amount of pips because it's actually giving you accurate information off the average of that price movement. It's not just something that it's not going to be 24 pips, 50 pips every single time. That's why I like it. And then it gives you targets both ways. Most ADRs is usually just one line. Some of them might be three. It's the open of the market. They'll give you a top one and a bottom one, and that's it. This one gives you 4 targets going down and 4 going up. So that's why I picked this one. That's why I use it. It's also part of the ketchup and mustard strategy is to use the ADR.
And you said you
So
use ADR switch.
yeah, put in SADR and it'll pop up. If you just put in ADR, you're gonna have to search for it a long time. You put in SADR and it'll pop up. And it'll say switch. All right. All questions, I'm done. Y'all got any questions? I checked the chat. I've answered most of those. This was a long session, much needed. Thank you, AC. And this is only halfway through it.